What's up guys, it's Sean and welcome to another episode of the iherng podcast, and today we will answer a question from email. This is from SY, right? Hi Sean, my wife's a friend of your wife. And I've been following your videos for quite a while now. Although they will be haters, but keep doing what you're doing, as more knowledge shared can only be good for everyone. Ultimately, each person has to assess the knowledge gained and see whether it works for them, so keep it up. Anyway, here to pick your brain. I'm currently looking to invest in more properties this year. A simple question I would ask is, if there is sufficient capital and holding power, will buying both new projects and subsale properties be a good strategy to diversify a property portfolio? Why I'm asking is because some people tell me that you should focus on a particular segment. For example, new projects cater to professionals and stable income earners, while subsale properties might be for lower income and single tenants. However, I believe like with all investment, diversification is key. What are your views? Thanks, SY. So first of all, thank you very much, SY, for the email, and thank you for the care, right? I think because of one of the later videos that caught a lot of hype, then there will be like a few people that thinks that I'm trying to sell stuff, but for those who really support the channel, again, thank you very, very much. So the key question is, now SY is trying to buy more properties this year, and if you are very familiar with investment, diversification is always part of the conversation. And how do we do that in properties? And I've thought about this like years back when I was trying to gear up more properties, exactly like where you are right now, and I think it's a very legit question, but it has nothing to do between new and subsales, unfortunately. So diversification, for me, there's a few parts to it. So number one, if we look across investment assets, right? So we can actually put on stock market, we can actually put on ETFs, we can actually put on crypto, right? Put on real estate, have some percentage of saving and things like that. So that's a portfolio of investment as a total one. Well, that works in general for people, but for me, it's very heavy on properties. So when I look into properties, right, how would I diversify? Number one, location. Because in different states, after visiting Johor, Penang, Ipoh, Seremban, the appetite towards investments are very different. The capital appreciation rates are different, the rental rates are different, especially in East Malaysia. But due to land laws, right, there will be a lot of restrictions for West Malaysians trying to buy East Malaysian properties. But if you're listening to this in KL right now, we are in the best zone for properties. So I guess diversification in location will be one. Number two, the other diversification will be in terms of building type. Okay, some will be on landed, some will be on high-rise, some will be on industrial, some will be on commercial, office, land even, right? Because if you come to think of it, right, if I have a lot of cash money, but then I'm trying to have more capital appreciation, I'll buy land. Or I want to go to a more safe kind of thing, I will buy residential properties because there will always be need for those. Then if I want slightly medium but then very high returns and things like that, maybe a conventional shop lot. But if I want to go high risk, high return, maybe a retail lot in a mall and etc. Right? So those can make a lot of money but can also lose a lot of money. And that can somewhat form into a portfolio as well if you were to go for diversification. Well, after those being said, right, ultimately when I start to think to myself, right, what is diversification? Diversification is only valid if you don't know what to do. It means, right, when you try to put every egg into one basket, you don't do that because once the basket break, then all your eggs are gone. But what if you are very certain about this person carrying the basket? For example, it's a person that is the most trusted, the most reliable one, or you just give to a person that's super clumsy and things like that, right? So I've seen investors that invest heavily, right? Maybe they take up 8 units, 10 units, they buy apartments per floor basis. There was once when I go there like, hey, why is this floor? Why you all lock this floor? No, a person bought the entire floor, a total 18 units of it because they want full control. Then I asked the same question, like, aren't you worried? You're only worried because you are not sure. They are pretty sure, they are very confident in their data, hence they are buying up a lot in the same property. Then for us who are less risk adverse, right, I will buy A lah, buy B lah, buy C lah, buy D lah. Then when you come to think of it, like maintaining all these different portfolios in different locations, right, will be multiplier of cost. In different locations, I cannot have shared resources. I need to appoint different teams to manage different properties altogether. If all of my investment is in one block, all resources are shared. However, again, when it goes kaboom, then kaboom lah. But when it goes very good, then good for you. Ultimately, what's the main difference, the main factor to create a difference in this diversification plan, right, will be your risk appetite, number one. Number two will be your capability. Personally, I've bought landed, I've bought high-rise, I've bought low-rise apartments, and you start to see the difference performance, right? And because of the channel as well, now I get to speak with a lot of property investors on my podcast, right? When they share like how they gear up into their 6, 8, 14 different properties. And it still boils down to that two factors. So profile A, I'm a low-risk person, right? But I don't have a lot of capital. So what do? You go for new properties because you don't need a lot of capital, but then there will be more uncertainties, and it will be a bigger risk if you are actually bought into the entire marketing plan. You don't know your data of rental and things like that. However, that's your only choice because you got no capital. Then profile B, you still have a low risk of appetite, but then your capital is there. This allows you to pay for certainty, right? The main difference when I look into this property buyer profile, right, is they buy things that are already making money. For example, they will go to these subsale properties, right? Then they look into the, okay, 600,000, I will look into the rental rates immediately. And after minusing 10%, which is their down payment, they will start calculating their loan, and immediately it breaks even or even have positive cash flow. And right on the spot, they make an offer and buy. Because to them, who can guarantee that next 3 years, next 5 years will be a double or triple, or as good as the saying goes, property double every 10 years, right? Who has that confidence, right, in showing you that magic ball of future, telling you, if it really does, right, why are you not buying personally? So coming back to this profile B, right, they will buy into subsale properties until they no longer have capital. Then only they fall back to somewhat profile A's behavior in buying new properties instead. So this is where I see them buying into conventional office lots. The first floor, second floor, always know people want, right? But then when you come to think of it, you calculate rental returns, they really let the numbers tell them what to do. Then moving on to profile C kind of thing. You're a high risk person, but then you have no capital. This is when greed happens, you know, when you have no capabilities, you have no knowledge, but then you want to just get rich. Then what happens is you fall into being a victim for a lot of marketing plans. For example, then you have different occasions where one person can buy 5 different properties because of discount. You will get very influenced for discount. I personally believe a lot of people kena con, they get cons only when they are trying to shortcut the process. Only if you are looking for a shortcut actively, you will bump into all these so-called opportunities for success lah, scheme cepat kaya lah, whatsoever lah. So this kind of profile, then I will not really encourage that much, because you should only invest the money you can afford to lose lah. Right, I'm in that kind of category. Then moving on to the last category is where these people have high risk and then they have high capital. So you see them buying land, you see them investing in development projects, you see them buying off plans like nobody's business. For example, I've witnessed a person, they are buying off project as if they are financing the project. This developer XYZ that was developing, I think 36 to 38 industrial properties, factories or whatsoever, warehouse, I also forgot already. Warehouse around KL suburb area. This group of investors then come in and, you know what? You got no money, but you got project. I got money, but I don't know what to do with it. I just come in and somewhat, let's buy 5 units, 10 units, just like that. Full cash. And you can only imagine the cost that they get. The market can go up to 2.2 million, 2.3 million, but they are buying like 800,000. So I've personally witnessed that before, but this kind of category, unfortunately, not everyone can be there lah. So I'm still in the route where I'm in between profile A and B before I can actually move over to D. So A and B is where when I have capital, I will try to look for certainty because I want cash flow. I will only buy things that is already making money. And the fact is, although a lot of people know this theory, not everyone is doing it, because who walks around with 80 to 100,000 in their bank account? right? The truth is not many of us, especially in this current situation of economy. So I'm balancing between new properties and subsale properties, new properties and subsale properties in accordance to a criteria that I set for myself. So my investment strategy currently is if I were to go for new properties, right, they'll fall into two types. One is listed under the bulk purchasing company that I've mentioned before. The other one is if it's not in their inventory, I will then go in and ask to make sure only one thing. I'm already earning when I buy the property. I need to know I'm buying at one of the lowest price around the proximity. For example, there will be like locations where they're going to be easily 30, 40 other projects, right? I need to know my competitive advantage. However, there's only so much that you can predict or guesstimate. Therefore, I'm also wandering around this auction market category, subsale market category, where when I buy, I already know the rental rates, I already know the condition of the property, I already know who's going to be the tenant, and etc. Just that the setback is the limitation factor will be your amount of capital. That until your 4th, 5th, 6th, right, it's going to be 30% down, 40% down, 40% down, 40% down. But what you're going to get is properties that are already making money. So coming back to YS, you need to discuss with your wife on your risk appetite first, like how much can you gear up to, right? Before I get married, my risk appetite was like supernatural kind of thing until I end up in AKPK lah. Not a very proud side of the story, but however, after I start to settle down, I learn the game a little bit more. Then now I'm gearing up with the certainty that I can afford the consequences if things go south. And since our wives are friends, right, I guess you will know that I've geared up recently on some new properties. Where I'm going into, right, because of this monopoly theory, like you need to have 3 houses before you convert them into a hotel. Similar, I'm like, okay, you have 3 residential now, time to go into something different. Maybe an office, for example, maybe a commercial lot, for example, but even industrial lots, if you look into their ROI, right, it's no longer like what we play in the residential market, like 5 to 7% is like very good. For them, it's like the baseline. But to enter the game, you need at least like 2 to 300,000 cash, at least. Yeah, and because of this kind of segments, the mortgage game is also different. Like if you're buying your third properties, for example, if it's a residential property, you can only get up to 70%. So where a lot of people go, a lot of people then go to commercial properties because anytime you can get 85%, that's like 15% higher, just that 15% over a bigger amount. So getting to know your loan appetite and looking into your cash account, like how much reserves you should have or how confident are you in terms of cash flow and things like that, that determines whether your behavior should be more of profile A or profile B. Subsale, unless you really know the property itself. Then if the property is completed for 6 months empty, can you afford it? And if you can, then I think it's okay. If you are into profile B, you can afford the down payment and things like that, you can immediately eliminate all uncertainties. That can also be a game. And in conclusion, diversification is not new or subsale, but it's more about location and category of properties. That's why for the rich, many they invest in UK, they invest properties in US, Australia, developed countries, right? And guess what? They made more money than whatever they did in Malaysia. But again, not everyone gets to play that game. Then some also they play across different categories: factories, land, hotels, shop lots, mansions, houses, and apartments, studios. Ultimately, the factors that will dictate your strategy will be 2 things: your risk appetite versus your capability, which is like how deep is your pocket lah. And with that, thank you very much, YS. So I guess the family says hi to your family, right? I really appreciate the encouragement. Don't worry about that. When I'm here putting out my thoughts, right, there will be people who disagree. Totally fine, and I embrace that. So it often keeps me on my toes. And with that, thank you very much for watching. And for those who still have any questions regarding real estate, do just email me at taniherng@gmail.com, taniherng@gmail.com, or you can just DM me on Instagram, iherng, and I'll see you on the next one. Ciao. When love comes in